Hello students, this is CA Vishal Jain, your faculty for ACCA SBR and SBR paper. Guys, as all of you are aware, okay, and have followed me multiple times about the SBR amendments. So this is a video on SBR amendment. Now, as we know that there are no major amendment in SBR, no major amendments, okay, and also there are no amendment from the point of view of IFRS, okay. Now, what is happening here is there is a change in the slight change in the question pattern. What is the change in the question pattern? Let's understand. Sir, ideally we used to get 4 questions in ACCA SBR. Question number 1, 2, 3 and 4. Question number 1 was of 30 marks. Question number 2 was of 20 marks. Question number 3 was of 25 marks. And question number 4 was of 25 marks. This was the paper pattern so far. Now, in question number 1, generally we saw a question on group accounts. In question number 2, generally we saw a question on financial reporting issue plus a ethical issue. Okay. In question number 3, we saw generally a question on financial reporting issue. Now, financial reporting issue, when I say, it means revolving around the standards. Okay. Now it can be revenue, it can be finance, it can be financial instruments, it can be share-based payments, it can be leases, it can be anything. Okay. Now it can be employee benefits. Now, question number 4 was also surrounding the financial reporting issue, but they also tested current issues, or you can say exposure drafts, or you can say technical articles. All these were tested. This was a traditional way of questions being tested. This is what we are aware of. Now, what is the paper pattern change? What is change in the paper pattern? Now understand, question number 2, question number 3, question number 4 remains constant as it is. Question number 1 changes. There is a slight change in question number 1. Now what is the change? The change is in this question of 30 marks, you will see a pre-populated Excel sheet, or you can say spreadsheet, okay, a pre-populated Excel sheet or an spreadsheet, okay, wherein the draft console SOFP or draft console P&L or draft console cash flow will be given. Now you have to make some adjustments to it and make it final SOFP or final console P&L or final console, you can say cash flow statements. So that's what is a change. Now this will be tested in the exam for 10 to 14 marks. This is a change. Now I understand that this is a welcome change. This is a welcome change. Okay, why? Basically, this is like giving 10 to 14 marks for free to the students. Okay, this is like a free lunch. This is like a free lunch, giving 10 to 14 marks for free to the students. Why free? Because we know that generally we are good at numbers. Where we struggle is the application. Right? And that was the area where I find students struggling a lot, how to exactly apply the standard in a practical life situation. Right? Now this point is like just the preparation of financial statements, similar to what you did in FR. Right? Similar to what you did in financial reporting paper, F7 paper at skill level. Right? So the only difference is they will give you a pre-populated file, okay, and you are required to just do the adjustments. So to do the adjustments, only point which I will be emphasizing here is you should have a complete grip over the console adjustments. Okay. Now you should have a complete grip over the console adjustments. Okay. Now the adjustments can be pertaining to console SOFP, it can be pertaining to console P&L, or it can be pertaining to console cash flow statements. Okay. Now what I'll do here is I'll take up a question. Okay. Now, and I will be explaining how exactly to deal with that question in the exam. Okay. Now this question which I am taking up is for console SOFP. Now similar type of question can come for console P&L or console cash flow statements as well. Okay. Now, so I'll present my screen and read the question for you guys and try to solve the relevant part where exactly there is a change, and I will show also what exactly is the change. Okay. So let's come. So I believe you can see this question here. So this is a question of you can say group accounts. Now the question here is you work in the finance department of Robbie. Robbie has recently appointed 2 new directors with limited finance experience to its board, and you have received an email from the finance director which is shown in the exhibit 1. Okay, fine. Now there are 5 exhibits. The following exhibits provide information about the relevant to the question. Exhibit number 1 is the email from the finance director. Exhibit number 2 is the details of the acquisition of the Hale company. Exhibit number 3 is the details of the joint operation. Exhibit number 4 is the draft opening console SOFP, and exhibit number 5 is the factoring agreement. Now see, exhibit number 4, this is the change, this is the change, this is the change. Draft opening console SOFP is given in the question, meaning thereby the question will ask you to prepare final console SOFP and make the adjustments to the console SOFP. Okay, you have to do the adjustments. Now let's come to the requirement. Requirement A1 is using exhibit 1 and 2, meaning thereby the mail from the finance director and details of acquisition. Explain the financial reporting principles that underlie the accounting goodwill. Okay, is this a change? Tell me, is this an amendment? Is this an amendment? No, it is not an amendment. Why? Because it is similar to what we studied previously also. It is just asking you to calculate goodwill and account for and explain the financial reporting principle around the goodwill, around the calculation of goodwill. That's all. So this is not a change. Point number A2, using exhibit number 1 and 3, that is email and the details of joint operation. Explain the nature of joint operation and explain the financial reporting principles that underlie the accounting of joint operations. Is this a change? No, it is not a change. It is not a change. It is not a change. Why? Because this is what we studied earlier also. Okay. Now coming to the third part, using the pre-populated spreadsheet response. Okay. Option along with the exhibit number 1, 2 and 3, adjust the spreadsheet. Okay, it is telling you to adjust the spreadsheet in order to prepare an updated console SOFP at 31st May 20x3. Okay, now as far as the information allows, whatever information is given to you using the exhibit number 1, 2 and 3, as far as the information is available to you, make all the necessary adjustments and make the updated console SOFP at 31st May 20x3. This is the question. Okay, now taking into account the following: the goodwill of acquisition on Hale. Okay, goodwill on the acquisition of Hale and the joint operation in the natural gas station. Okay, you do not need to adjust the pre-populated spreadsheet for the issues in exhibit number 5. It says that this adjustment in the pre-populated sheet should not adjust exhibit number 5, that is factoring agreement. Okay, so we will totally ignore it off. So now in this class, now in this session, what are we going to discuss? Will we discuss A1? No. Will we discuss A2? No. So what are we going to discuss? We are directly going to discuss A3. Though to solve A3, we are supposed to discuss A1 and A2 as well. So we will discuss the relevant parts of it and move ahead in the class. Tell me, is it clear, everyone? Tell me, is it clear, everyone, so far? Okay, now let's come to exhibit number 1. What is exhibit number 1? To accountant from finance director. Okay, new directors. Subject is new directors help required. Okay, now basically this is an email from the finance director. Okay, it from the account to accountant. So the finance director needs help from the accountant. Okay, now subject is help required. Hi, our 2 new directors are keen to understand how Robbie company's investments in other companies are reflected in the group financial statements. Basically, the new directors wants to understand how the investment that the Robbie does is reflected in the group's financial statements. Now, I would like your help in explaining how to account for the goodwill on the acquisition of a subsidiary and in how to account for the joint operation. Please use the acquisition of Hale exhibit number 2 to explain the financial reporting principles that underlie the accounting for the goodwill on acquisition of subsidiary. You should use the gas station operation exhibit number 3 to explain what a joint operation is and explain the financial reporting principles that underlies the accounting of a joint operation. Okay, now is there anything to be explained here? It is just saying that you are required to explain the accounting treatment of goodwill and the joint operation, and the details of the goodwill is given in exhibit number 2 and the details of the joint operation is given in exhibit number 3. That's all, nothing else, nothing new so far. Okay, now console SOFP have not yet been prepared, but our accounting software have added together the individual FS of the financial position of the Robbie and Hale exhibit number 4, that is pre-populated spreadsheet. Okay, now you can use which you can use to show how the goodwill in the Hale and joint operations should be accounted. Basically, you have to use the pre-populated spreadsheet. You have to use the pre-populated spreadsheet. I will not write here Excel sheet. I'll write here spreadsheet. Okay, that's the correct term to say. Spreadsheet will be a wrong term to say. Okay, we have to use the pre-populated spreadsheet to adjust for the changes in exhibit number 1, 2 and 3. In 1 we saw it is just an informative. Exhibit number 1 is just saying that what needs to be done, so let's ignore exhibit number 1 from now. So we have to go through exhibit number 2 and exhibit number 3, and so how will these be presented or adjusted in the pre-populated spreadsheet is what we have to do. Tell me, is it clear to everyone till here? Now, and I guarantee you, I promise you that I will not be teaching anything new to you guys. Whatever we have discussed in our classes is what we will continue. Just the presentation will change. Just the presentation will change, and the presentation is not something difficult. Is something which we have already studied in FR level. Is something which you have already studied at FR level. Rather, I say it is easier than what we have studied in FR level. Why? Because in FR we have to do in FR what happens, we have to prepare the complete set of FS, complete set of group FS. But at SBR level, if this for this change, we are just required to make the adjustments. That's all, nothing else. So you have to be very mindful. That's all, nothing else. Okay. So let's read the exhibit number 2 and exhibit number 3 and try to solve the questions. Okay. Now let's come to exhibit number 2. So it says on 1st June 20x2, meaning thereby at the start of the financial reporting period, Robbie company acquired 80% equity interest of Hale, obtaining control over Hale company from that date. The purchase consideration comprised of cash of 50 million payable on 1st June 20x2, meaning thereby on the same date. Okay, now 24.2 million payable on 31st May 20x4 and now a further amount payable on 31st August 20x6 million. Now there are three considerations. Now understand, one is the cash consideration of 50 million, another is the amount of 24.2 million payable on 31st May 20x4, meaning there is a fixed amount of money payable after a fixed period of time, and the payment is also fixed, Now 24.2, so it is called as deferred consideration. Why? There are 3F getting satisfied: fixed amount, fixed time, fixed payment. Second point is a further amount is payable on 31st August 2006 if the cumulative profits of Hale company for the 4-year period this much exceeds 150 million. Now what happens here is, this further amount which is paid on 31st August 2006, the amount is not given. Okay, now but it should be paid after a fixed period of time. And the payment is also not fixed. Why? Because it is dependent on some future conditions, that is satisfaction of some future conditions. Now if you can recall, I discussed in my class that if a payment is dependent on some future conditions, it becomes what? Contingent consideration. Now in this question there are three things: cash consideration, deferred consideration and contingent consideration. Now you know cash consideration is recorded at the amount of cash being paid, deferred consideration is recorded at its present value, and contingent consideration is recorded at its fair value on the date of acquisition. Okay, now what is the question asking? What is the question saying further? See, only the cash consideration paid was accounted for in the Robbie company's individual financial statements. Okay, meaning thereby we have to give the impact of this 24.2 and impact of this contingent consideration in the draft console SOFP. Okay, just to give you a look of it, okay, just to give you a brief overview of it, just give me a minute, I will share the screen. Okay, now so this is the draft pre-populated spreadsheet that is given in the question. This is the pre-populated spreadsheet as part of exhibit number 4. See, exhibit number 1 is the email, exhibit number 2 is the this one, details of acquisition of Hale, Exhibit number 3 is the details of joint operation, and exhibit number 4 is the pre-populated spreadsheet, which you have to adjust for all the adjustments in exhibit number 2 and exhibit number 3. Okay, now, so what we will do here, so first of all we have to adjust for the deferred consideration and the contingent consideration. So let's do it off. Okay, let's write here. So what we'll write here, deferred consideration. Okay, now, so what is the impact of deferred consideration? Deferred consideration, first of all, it will increase my investments, but at what amount? Now, amount payable is 24.2, discount rate was 10%. It is to be paid after how many years? 2 years. So 24.2 equals 24.2 divided by 1.1 to the power square. Just give me a minute. Because 24.2 divided by 1.1 into 1.1, right? Divided by 1.1 into 1.1. You can say square itself. Okay, this is what it is. It comes to 20. 20 is the present value of the amount being paid after 2 years. That is 24.2. Per 20 is the present value of 24.2 for 2 years. Now, this is one impact. It will increase my value of investment because it will increase the purchase consideration, right? Subsequently, what we have to do is we have to record this as a part of liability also. Now comes the question, when are we preparing this? We are preparing on 31st May 20x3. We are preparing on 31st May 20x3. Now tell me, on 31st May 20x3, is it a current liability or a non-current liability? Now tell me, when is it payable? On 31st May 20x4. When it is payable on 31st May 20x4 and we are standing on 31st May 20x3, it becomes current. So what we'll do, I will add here also 20. So this is what is the treatment. Tell me, is it clear? Now coming to contingent consideration. Now, contingent consideration. What is the fair value? See, the question says that on 1st June 20x2, the fair value of the contingent consideration was 40 million. So what I'll do, again, it will increase my investments. And now when is it payable? Tell me, when is it payable? On 31st August 20x6. We are standing on 31st May 20x3. After 3 years, meaning thereby it becomes non-current. It becomes what? Non-current. So I will add here 40. Now what I'll do is I will just right here, so that you get to know that the impact of the transactions remains the same. Just give me a minute. I will show using the formula. The impact will remain the same of these transactions, these impacts. Just not sum. Copy, paste. Now sum done. See, so impact remains the same, 20 here and 20 here, 40 here and 40 here. So this is of the treatment of deferred consideration and contingent consideration on the date of acquisition itself. Okay, now further we have to do the unwinding of deferred consideration. We have to record the fair value changes of the deferred consideration, right? Tell me yes or no. Right now, so what we'll do the unwinding. Now unwinding of deferred consideration. Okay, now tell me what is the discount rate. Discount rate was 10%. Now when the discount rate is 10%, so what is the finance cost on deferred consideration? 20 multiplied by 10% is 2, right? So will it impact the investment? No, it will not impact the investment. So what will happen? It will be recorded as a finance cost in console P&L, which will reduce my retained earnings. So what I will do minus 2 here. Okay, or I can do here this 20 multiplied, I cannot do that because it equals to minus 20 multiplied by 10% is minus 2, right? And now this minus 2 will increase my this one also, right? It will do plus 2 because it will increase my deferred consideration. It will increase my liability. Tell me, is it clear, everyone? Is it clear, everyone, so far? Now further. This fair value was remeasured at 42 million on 31st May 20x3, meaning thereby the contingent consideration contingent consideration, the fair value increased by 2 million. Okay, it became 42 million. So what we'll do, we'll record here, it increase, fair value is increasing. Now what happens, fair value is increasing, so what happens, if the fair value increases, it is an increase in your liability, it is an increase in the contingent consideration, right? So what happens, it will again, you have to record an expense of 2. Okay, and here you will have to record this one also, plus 12 plus 2. Tell me guys, is it clear everyone till here? Tell me. Okay, so we have just done the accounting, so now with this accounting, this brings in the complete treatment of deferred consideration, and this completes the treatment of contingent consideration. First of all, we recorded the initial value on the date of acquisition, then we recorded subsequent treatment, subsequent values of the deferred consideration, the unwinding impact, and for the contingent consideration, the change in the fair value we have recorded. I hope it is clear to everyone till here. Now further the question says that, I will present my screen. See here, the fair value I have taken from here, 42 million and 40 million. Now the question says that on the acquisition date, the carrying amount of the net assets was 130 million. Now total purchase consideration, how much? Tell me. Purchase consideration was how much? Cash, present value of deferred consideration, and fair value of contingent consideration. Okay, now so cash is how much? Tell me. Cash is how much? 50. Present value, this one is 20. Fair value is 40. So total is how much? 50, 70 plus 40, 110. Right? Now see what happens here. The percentage stake that I have acquired is how much? 80%. So 20% will be NCI also, right? So NCI on date of acquisition. And now if you know, the NCI can be measured, the non-controlling interest can be measured using two methods, the fair value and the proportionate share method. Okay, which should be given in the question, which method to be followed, fair value or proportionate share method. If nothing is mentioned in the question, then follow proportionate share method. Now then less fair value of net assets on date of acquisition. Sir, where do we need to show these workings? In that screen also, in that spreadsheet itself, you have to show the working. Okay, but this is what I have explained earlier also, this is what we discussed earlier also. So my focus is just to show how to make the adjustments in the pre-populated file. These adjustments I believe definitely you can show in the spreadsheet. Okay, but my discussion in this session is just to discuss how to adjust in the pre-populated file is what I am going to discuss, rest nothing else. Okay, now rest all I will write here, and whatever I am writing in that screen is just the adjustment should be done. Okay, now further So what is the net assets? So it says on the acquisition date, the carrying amount of net assets was 130 million, which was equal to the fair value at that date. Okay, now it says is 130 million. Okay, and the breakup is ordinary share capital of 80 million and retained earnings of 50 million. Okay, we'll discuss about it also. Now tell me, the notes to the financial statement of HALE at acquisition disclose a contingent liability. Okay, now it says the HALE company which I have acquired, the HALE company which is acquiring company which I have acquired had a contingent liability. Now tell me, what is the treatment of contingent liability? We record the contingent liability of the acquiring company at the fair value on the date of acquisition, right? Now what is the fair value of the contingent liability? Tell me. 2 million. So what will happen? The net assets will get reduced further by 2 million, right? So it will become how much? 128 million is the value of net assets. Now what will you do? Tell me. Further it says non-controlling interest had a fair value of 30 million. So fair value of NCI is 30 million. Now can you please calculate goodwill? So 110 plus 30, 140, 140 minus 128 is 12 million is your goodwill. Now how to record this goodwill in the financial statements? Now if you can recall my regular classes, I told that how to record goodwill. How to record goodwill? The journal entry for recording the goodwill is like this. First of all, the investments in the subsidiary company is not recognized in console FS. Okay, it is recognized in the separate FS of the parent company. We have to de-recognize that in the books of console company, console group accounts. So what we'll do? We will de-recognize the investments. Sir, if we have to de-recognize the investments, then why we rectified the value of investment in the console SOFP in the pre-populated file? Because to de-recognize also, we have to first arrive at the correct amount, right? So first we rectified it and then we de-recognize it off. So investment will de-recognize at 110 million. Then we will recognize what? We will recognize what? Net assets. At what value? Tell me. We will recognize net assets at what? Net assets account debit to at what value? 128 million, right? Now 2, we will record NCI at what value? 30 million, right? So tell me what is the value of goodwill? Tell me what is the value of goodwill? What is the value of goodwill? Tell me. Tell me what is the value of goodwill? Goodwill account debit, tell me how much? 12 million. 12 million. Now, how to present this in the financial statements? How to present this in the financial statements? I will first of all discuss that and then I will present that. Okay. Now, tell me net assets is presented by what? Net assets is presented by what? It is presented by share capital and retained earnings. If you can recall the statement of net assets that we discussed in our class, right? So what is the share capital? It is given in the question. What is the amount of share capital? 80 million. 80 million is the amount of share capital and retained earnings is 50. 80 and 50. 80 and 50. Sorry, I will use this color. 80 million and 50 million. Sir, this becomes 130 million, but the net assets are 128 million. Okay, fine. Fine. I will do the accounting for that also. We have to recognize a contingent liability also, right? So to contingent liability, how much? 2 million. So now does it give net 128 million? Yes. Now what about goodwill? So record goodwill account debit. How much? 12 million. Now investment. So de-recognize investments. How much? 110 million. Now to NCI. How much? 30 million. Now this is what is the adjustment that you have to do in the pre-populated file for recognizing what? Goodwill. For recognizing what? Goodwill. Now come to the pre-populated file. Let's come to the pre-populated file. See, it is here. So now, so let's write here, sorry. Goodwill. Now how to record goodwill? So first of all, what we'll do? We will record reduce investments by what? 110. Then what we'll do? We will record goodwill by what? 12. By what? 12. Then what? We will reduce the equity capital by how much? Equity capital will be reduced by 80. Retained earnings will be reduced by 50. Then we will record a contingent liability of what value? Tell me. We will record a contingent liability of what value? Tell me. 2 million, right? So I will record a contingent liability of 2 million. So now tell me further, I have to record a non-controlling interest of what value? 30 million. Tell me. So is it adjustment getting tallied? 98 negative, 98 negative. So this is what is the treatment for the goodwill. We reduce the investments, we recognize goodwill. Reduce investment, basically investment is set off by the equity capital and the retained earnings, and the differential of investments, equity capitals and retained earnings and NCI goes to the goodwill. That's all. That's all. Okay. NCI 30 million. Okay. So NCI is increasing. See, let's come to the notes again. Let's come to the notes again and just understand it. See, equity, net assets, that is share capital, we have to reduce. Share capital we have to reduce by 80. Retained earnings we have to reduce by 50. That's what we have done. That's what we have done. Now goodwill we have to increase by 12. That's what we have done. Contingent liability we have to increase by 2. That's what we have done. Investments we have to reduce by 110. That's what we have done. NCI we have to increase by 30. That's what we have done. Are we studying anything new? Are we studying anything new? I don't understand. I don't think so that we are studying anything new. Okay, I don't believe that we are studying anything new. It's just these journal entries I have explained in detail in our classes, in our live classes, in our regular classes, and now we are just making these adjustments in the FS, which is a practical way of understanding things. That's all. That's all. Okay. So I don't think that we are studying anything new here. Tell me, is it clear everyone so far? Is it clear everyone so far? Tell me guys, come on, all of you. Now, so we have recorded this exhibit number 4 is, sorry, exhibit number 2 is done. Exhibit number 2 is done. Now what is pending is exhibit number 3. What is pending is exhibit number 3. Now let's come to exhibit number 3. So in exhibit number 3 deals with joint operation. Okay, we very well know the accounting treatment of joint operation. I believe I'm not discussing to that point, but just to give you a brief understanding, we, in case of joint operation, each of the joint operators take their own share of assets, take their own share of liabilities, take their own share of you can say expenses, and takes their own share of income. Okay, so this is what they do. Okay, now here what the question says here is Robbie contributed 40% to the cost of constructing a natural gas station and holds a 40% share in the gas station. As a result, no separate entity was set up under the joint operation. Assets, liabilities, revenue and cost were apportioned on the basis of the shareholding. Okay, fine. The natural gas station cost 15 million to construct. Okay, now and was completed on 1st June 20x2, and it is to be dismantled at the end of the life of 10 years. The present value of the dismantling cost of the joint operation at 1st June 20x2 was 2 million. Now tell me, what is the cost of natural gas station? Is 15 plus 2 is how much? Tell me, is how much? It is how much? Tell me, 17 million. Out of which, how much Robbie owns it? Tell me, how much Robbie owns it? Robbie owns how much? Tell me. Robbie owns how much? 40%. So now on 1st June 20x2, on 1st June 20x2, Robbie owns 40% of it. Is 17 into 0.4. 17 into 0.4 is 6.8. 6.8. Right now, during the year, Robbie will charge depreciation on that. Right? What is the life? Tell me, what is the life? Life is how much? 10 years. So the life is 10 years. So divided by 10 is 0.68. Right? Now, what is the closing balance on 31 May 20x3? On 31st May 20x3, what is the closing balance? Is 6.8 minus 0.68 is 6.12. Right? So let's upload this in the file. Come here. Now, so I will write here joint operation JO. Okay, for JO, what I will do here is in PPE, I will add how much? Plus 6.8 minus 0.68, right? And now this 0.68 will be adjusted where? Tell me. It will be adjusted in the written annex. So minus 0.68. Tell me, is it clear everyone till here? Tell me, is it clear everyone till here? Okay. Now further, come back to this one. Notes. Now what happens in the notes? It says further, okay, now it is a decommissioning liability. So we have to record the decommissioning liability also. Now what is the provision? What is the provision for decommissioning liability? What is the provision for decommissioning liability? Tell me how much? 2. And my share is how much? My share is how much? 40%. So it is 0.80. But this value is on 1st June 20x2. Plus I will add the finance cost also on that, right? What is the discount rate? What is the discount rate? 5%. So 0.8 multiplied by 5%, 0.8 multiplied by 5% is 0.04. 0.04. Now the students will make a mistake in the exam is, so first they calculate 0.8, and when they calculate finance cost at the rate of 5%, they calculate 0.04. Now they will take the 40% of this also. Boss, understand, we have calculated this 5% only on the 40% itself. So don't again do the 40% adjustment. Okay. Now, so what is the value of provision for decommissioning liability at the year end? 0.84. 0.84. 0.84. Right. So the liability gets unwind. We have to unwound the liabilities. Now let's adjust that also. Come to the screen. Now, so what I will do, see now tell me provision for decommissioning liability will be incurred when? At the end of the 10 years. So it is a current or non-current? It is non-current. It is non-current. So let's write here in non-current how much? 0.8 on 1st January 2002, then plus 0.04 plus 0.04 on what? On what date? Tell me. It is on what date? On finance cost during the year. So this gives me the value of the provision for decommissioning cost at the year end, that is 31st May 20x3. Now 0.4 is my finance cost, so let's adjust it here. So minus 0.04 is my finance costs, minus 0.04, not 0. 0.04 is your finance cost. Okay, now so this is the treatment of finance, this one decommissioning liability, right? I believe it is clear to everyone till here. Now again coming to the question, the only accounting that has taken place to date is to record the investment in the joint operation of 6 million in the individual financial statements of Robbie. Now what we have to do, we have to de-recognize this 6 million. We have to de-recognize this 6 million, okay? Because whatever investment we incur, whatever investments we made in the joint operation or subsidiary in the group FS, we have to de-recognize that. So now let's come again to the screen. Now, so what we'll do, we will de-recognize the investments, minus 6, right? So now just see for the joint operation, is the impact coming clearly? 0.12 and 0.12. Impact is clear. Now this is your final SOFP. This is your final SOFP, which is the question requirement. I will highlight this also. In red color. This is the requirement of the question. This was the requirement of the question. Now what I will do here, I will just do the total. That's all done. Equals to sum. This tick, 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 done. Now I will do copy and paste till here, and I will do this one, current assets. Just a minute. Copy and paste. Okay. Then I will copy paste. Then copy paste. Right, 469.12 and 469.12. see the balance sheet is telling, the statement of financial position is tallying, statement of financial position is tallying, right? So this is what is the amendment. I don't think that it is something a very big an amendment, because this is something which you already knew. It is just the presentation changes, and scoring 14 marks for this, giving 14 marks for this is something I understand is giving 14 marks as a free. Take it off. Okay, it's giving 14 marks for free. Okay, so clearing SBR it become relatively easy now. Okay, so that's all for the day, guys. Thank you. Bye bye.